home loan performance continues to get healthier. That's our topic for this morning's Backstage Pass. Good morning, I'm James Lopez, President at HomeFi Corporation. Before we get into our deep dive this morning, I want to talk about a few data reports that came out over the last couple of days that were kind of overshadowed by the Fed meeting. We'll talk about that in a minute as well. But first, let's talk about initial jobless claims in the jobs report. Initial jobless claims, which measures individuals filing for unemployment benefits for the first time, was reported at 229,000 claims for last week. Now, this represents a decrease of 3,000 from the previous report, but it was higher than expected. Continuing claims increased by 3,000 to 1.312 million claims, and this was also higher than expected. And you can see the graphic on the screen right now. You can see the largest claims, largest increase in claims came from California, Texas, and New York. Also, in other news, the National Association of Home Builders released their data for housing starts for the month of May. Showed housing starts declined by 281,000 units to about 1.549 million units in the month of May. And housing permits also declined. Housing permits is a good indicator of future starts. That was down by about 128,000 to 1.695 million units. Now, on to our deep dive this morning. I want to talk about home loan health here in the United States. CoreLogic released their report about home loan health, and it showed that homes with mortgages that were 30 days or more delinquent fell from 3.2% to 2.7%. Homes with mortgages that were 90 days or more delinquent fell from 1.6% to 1.4%. And then homes that were in foreclosure stayed at around 0.2%. And that's the multi-decade low. That's the lowest it's been in decades. And this is what I want to talk about. Home loan health in the United States is strong, and this is great news. Now, there's a lot of talk in the media and about a housing bubble and our home values going to decline and all that kind of thing. Here's a big difference between what's going on right now in the United States, specifically in home loan health, and what happened during the housing bubble of 2008. During 2008 and the years prior, there were several millions and trillions of dollars of mortgages that were issued called subprime mortgages. And these mortgages were issued to people that really couldn't afford the mortgage that they were giving. One of such mortgage we've talked about, you've heard it before, it's called a ninja loan, the no income, no job approved loan. All you had to do was provide stated income. You say, I make X dollars a month, have a decent credit score, and you got a loan. So those risky subprime mortgages were given to people that couldn't afford them, and that was being driven by a mortgage-backed security market that was asking for more mortgages. So they were asking for more securities. So we had kind of two things going on. You had mortgages that were being originated to people that couldn't afford them, and you had a mortgage-backed security or secondary market that was demanding or asking for more and more and more mortgages. So what wound up happening? Well, people that couldn't pay those mortgages, they went into default, and all those homes went into foreclosure. So all of a sudden you had a massive amount of homes that came on the market in foreclosure. They were being priced for less than what was even owed on the house. You had several mortgage companies that went out of business, and basically these homes had to get sold, and so they were priced aggressively to sell, and it caused a crash in the housing market and a crash in housing prices. So here's the contrast between that and now. Home loan health in the United States is incredibly good right now. We see 30-day delinquencies decreasing, we see 90-day delinquencies decreasing, and we see foreclosures at multi-decade lows. This is good news. And so, you know, for everybody that's out there, you know, there was people in the media last year talking about how the forbearance was going to cause a huge, you know, default in mortgages. That myth's been debunked. And for everybody that's out there thinking that or talking about a housing bubble, look, this is one of those reasons why we don't see home values declining. Instead, we see home appreciation decelerating from 20% year over year to about a normal range of 5%. We did a video on that a couple days ago. Go check that out. And lastly, let's talk about mortgage bonds. All right. So yesterday, Fed meeting was announced, and if you've been hiding under a rock and you haven't heard, the Fed announced a rate increase for the Fed fund rate of 75 basis points. Mortgage bond market reacted very favorably after that announcement and during the press conference that was held by Fed Chairman Jerome Powell. The mortgage bonds reacted very favorably, kind of erased the losses that we had seen over the past 2 days, Monday and Tuesday. However, this morning, mortgage bonds have opened up and are down pretty significantly, kind of erasing the gains from yesterday. So we're on a little bit of a back and forth right now, a lot of volatility in the bond market. Mortgage bonds are down 46 or 56 basis points right now. But the 10-year yield is down 3 basis points right now as well. And you know, the weakness in the bonds is actually coming from a surprise announcement from the Swiss National Bank to do a rate hike of their own fund rate, completely unexpected, and so it kind of shook European bonds, and that kind of carried over into the bonds here in the United States. Now, the fact that the 10-year yield is down and mortgage bonds are down at the same time kind of tells me that there could be some room for improvement on the mortgage bond. Right now, what it means for mortgage interest rates today, interest rates are going to open probably where they closed off yesterday, which was better, in some cases 50 basis points better in some cases. So we should see mortgage interest rates open about the same today. Could be in reprice territory for the better, but you know, any news items right now that normally don't move the market are market movers. So anything can shake the market right now. So we'll keep a close eye on it. If we see any reprice for the worst coming, we'll be sure to let you know. All right, that's all the news we have today. Please like, comment, and subscribe. Make sure when you subscribe, you hit that bell icon to get notified as soon as we release these videos. We release these daily. If you have any questions, leave a comment. Would love to hear from you and answer any questions that you may have. Thank you so much. I hope you have a great Thursday. We will see you tomorrow.